Deriving financial payoff, such as net present value of a project that aid financial decision, can be tedious and complicated in the syllabus of the AFM exam. This is true especially if the project is located abroad. Have you got a clue how to derive such measurement in an efficient and effective manner in the exam? Hello, my name is Tze Kang, the expert tutor for Advanced Financial Management, AFM. This topic explainer is about international investments and financing decisions. In this video, discussions on such topic for international investment and financing decisions will be made with reference to the ACCA resources, namely Study Hub, referring to the following chapters for learning purpose. One may refers to 17.4, particularly on international capital budgetings by applying techniques such as net present value in particular, in addition to other techniques such as adjusted present value would be worth reading up. For practice purpose, students would take a look at the following questions on the quizzes, exam format revision questions, as well as the study questions pertaining to international operation. These are the exercises that is worth practicing. Last but not least, in terms of additional reading referring to the technical articles, there are two articles, namely International Project Appraisal Part 1 and 2, that is highly recommended for spending time in getting a better understanding from the content. Last but not least, let's not forget about going through ranges of past exam questions in the practice platform, going through comment and suggestions from examiners in the examiner report will be worth spending time on it. In this video, we will first take a look at what does it mean by international investment, followed by how to assess such investment to derive the decisions to be made. And finally, a demonstration will be made by attempting one of the exam questions on the practice platform. What exactly gave rise to international investment? Well, let's imagine if there is a company by the name A, which is located in home country, whereby the underlying currency is denoted by dollar, for instance. Company A would most likely carry out some ongoing or existing business operations in the homeland. As part of the expansion plan to grow the business further, referring to the strategy that suggested from the ANSOF product market matrix, company may expand the businesses via product development, market development, or diversification. If any of these growth strategies were to be pursued via one of the growth modes, namely organic growth, the company may have a choice, an option to expand the business operation in addition to home market. It may be equally possible to explore overseas market to expand and reach out the business operations at abroad. Let's refer these as the host country, whereby assuming the underlying currency is denoted by TB. As the first step for company that venture into abroad market, it is likely that as part of the organic growth move to set up a newly incorporated company, which could be a subsidiary that owned by the holding company in home country. What's in the subsidiary company located in host country? Most likely, for instance, this newly set up subsidiary may host series of new outlet, branch, factory, many other form of business activity that carry out at host country. The ownership of this subsidiary, however, it still remain mainly or wholly owned by the holding company A. This kind of investment to company A is then termed foreign direct investment, FDI in simple. That gives rise to international investment. So, Before putting a footstep into a broad market to set up a permanent establishment for a newly established subsidiary, it is a need for the company to undertake a thorough and rigorous studies on finding out is it worth putting up a presence in a broad market. So here comes the question, how are we to assess the international investment? In other words, how are we to derive such investment decision? Well, to answer these questions, one of the models that you may have learned in some other paper like SBL would have given you the convenience to carry out such assessment. And the model or the framework that will be applied will be of the SAF framework, which I would suppose most of us would know what exactly it stands for. The study on suitability, acceptability, and feasibility on a particular proposed investment will be worth taking out. In the context of assessing the financial payoff of a project that located abroad, assessing the acceptability or the viability is the one that catch the attention, particularly relating to financial evaluation. Well, these measurements may be carried out by looking at the financial payoff. The most commonly used technique of such measurement would therefore be the net present value in simple, or NPV. In the exam, the measurement of NPV may sometimes, instead of just relating and reflecting the viability of it, it may be possible to reflect the suitability of the project by narrating and indicating if this project would have created additional wealth for the shareholder that would indicate the alignment to the objective of the firm. So guys, have you got a clue? How do you carry on the calculations of net present value for a foreign direct investment in a systematic manner? Well guys, there are many ways of presenting the calculations of NPV. This is one of the suggested way of producing and narrating the NPV in a systematic manner on the computer-based exam platform in this examination. First and foremost, to set up the table to derive the NPV, one should take note. It is only cash flow that are of relevance. At the same time, this cash flow need to be of future and specific to the project. All these are the feature. Future, specific, and cash flow related will make up what we call by relevant cash flow. Only relevant cash flow are to be included in the calculations of net present value of FDI. Given the fact, as mentioned a moment ago, the establishment of these foreign direct investment is at abroad, majority of the business activity and transaction would have taken place in host country. It is therefore recommended and make more sense to start off by compiling, accumulating all the relevant cash flow arising in the host country, which denominated in the currency named TB. So guys, there will be a ranges of cash flows. Some of it could be outflow of cash, such as investment in the asset. Some of it could be in the form of inflow, like revenue. And all these calculations of the relevant cash flow in FDI may have affected by ranges of complexity, which I would like to draw your attention, what are they, and how exactly you have to pick up this kind of information from the storyline. First and foremost, when we are to recognize the relevant cash flow that take place in the host country, let's not forget about to include those cash flow that representing transfer price value from home country operation at the holding company. The common example in the exam of AFM to give rise to this transfer pricing item could be of royalty imposed by the home country operation and charging to the host country operation. That is one of the transfer price items that we have to capture as a form of cash outflow. Other than royalty, what if the host country operation, the FDI, purchased component or parts from the home country operation? The purchase price would therefore representing another cash outflow that we have to capture at the host country. So these transaction value, which originally denominated in home country currency, that is dollar sign, will need to convert into host country currency, that is TB. Then only it will be captured and reflected into the series of this cash flow item over the year. Furthermore, other than the cash flow arising from the host country operation, let's not forget about another cash flow item pertaining to tax payment to the tax authority. Tax cash flow, to be more precise, it could be tax payment or tax saving arising from taxable items that refers mainly to taxable profit or allowable losses arising from the host country currency operation. These tax cash flow will be derived by taking the tax rate in the host country multiplied by the taxable item in the host country operation. Let's not forget about to mention, taxable item is not exactly equal to the total of the cash flow in the host country. Guys, you should know what item make up of taxable item, not to mention all revenue, tax allowable expenses, including tax allowable depreciation. These are the common themes items of TIs. So once we derive the tax cash flow in the host country operation, it is common that taxable item at the early year of the project could turn out to be a loss making. That was supposed to give rise to tax credit or tax saving. But are we allowed to claim back this tax credit from the government? Guys, here comes another catch that you have to take note regarding the treatment of losses. Let's check if the questions mention whether there are other sources of income allowing us to take advantage on the tax saving. If yes, the tax saving will be recognized in the year that we're supposed to get back the tax credit. Alternatively, if the questions say there is no other sources of income to offset, the questions may then tell you you may allow to carry forward these allowable losses into the future to offset the future profit. Either way of the tax treatment on the losses will cause a difference in the result of the tax cash flow. So guys, please take note on which of it will be applied in exam. Lastly, let's not forget about the timing of tax payment. Whether the tax is paid 1 year in arrear or in the year the liability arising. That will determine the appearance of this figure, whether in the same year or a year later. Once these cash flow from host country, including the tax cash flow, were found, we will then be able to derive net cash flow after tax in the host country operation that is ready to be remitted. And let's take note on the other catches in the calculations of NPV for FDI. That is about remittance policy. Most of the time, this kind of exam questions would have told us that remittance of the cash flow is up upon the willingness of the company. In other words, the questions may have told you the cash flow that's supposed to be remitted would be assumed to remit at the earliest possible time. That is when we say remittance can be made annually. At the point of time where the cash flow arises, we will then remit back to home country. In the very rare occasion, even the questions is tested on the other cases, it will likely to be tested in a narrative form of questions. What is that? When there is a restriction on the remittance, which remittance can only be made on the block basis, then it will affect the remittance of the cash flow. Instead of annually, it only can be remitted at one point of the time later. In this demonstration of the video, annual remittance is therefore assumed. So with these net cash flow after tax to be remitted, on the annual remittance assumption, it will then converted by remitting the cash flow from host country back to home, and these remittance will have to be converted based on ranges of foreign exchange rates, Forex rate in simple. Starting with year zero cash flow will be converted into home country currency based on spot rate. As for the rest of the exchange rate that remain unknown, we may have to predict using one of the following parity model. Namely, purchasing power parity would be used if inflation rate of the two countries is provided. Alternatively, interest rate parity may be used if interest rate of both countries are given. Once the conversion is made based on these series of foreign exchange rate, here comes the net cash flow after tax remitted into home country currency, namely dollar. So with these net cash flow remitted, let's not forget that it's a high possibility there may be other set of relevant cash flow pertaining to FDI, however, that take place in home country. So these are the home country cash flow. And let's not forget about these may include transfer price item that mentioned above. So this item is connected to the transfer price cost that's shown at the above. From the home country viewpoint, the royalty charged to the host country would now become income. The item of component or parts that transferred host country, that become our revenue. As such, transfer price would include royalty income or the sale of component. These value that denoted by X dollar in red color is the same as the above, except the one at the above will have to convert it into host country currency in order to reflect in the cash flow at host country. Whereas in home country, this X dollar would reflect a form of cash inflow for home country operation. As far as royalty income is concerned, the entire royalty income, which is the red color of the X dollar, will be shown in these cash flow. However, when there is a sale of component or parts, these X dollar, however, are not allowed and not supposed to reflect into the cash flow table of the home country because they also have relevant costs incurred for the home country operation to produce these items. So let's not forget, guys, to recognize the variable cost of making these component or parts until revenue, which recognized as the transfer price cost above, now it is recognized as income for home country operation, will then have to offset with the variable cost to derive the contributions in home country operation. In other words, it is this amount, the X dollar of contribution, that will be shown in the cash flow at the home country. Once we have the net cash flow remitted and the home country cash flow, guys, let's not forget about the tax. Keep an eye on tax cash flow pertaining to taxable item from host country, which originally is stated in TB. These taxable items may have included into the net cash flow remitted. Once the money brought back to home country, one have to take note the policy on double taxation between both the country of home and host. In other words, when we bring in the cash flow from host country, keep an eye, do we need to pay additional tax on these taxable item in the host? That depends whether there is a presence of tax treaty between the two countries. Should there isn't any tax treaty or bilateral tax agreement, the entire taxable item from host country above would then have to pay at the full tax rate at the home country. Let's not forget to convert this taxable item in the host country from TB to home currency of dollar sign to determine the additional tax cash flow. However, most of the time, the exam questions may have mentioned the presence of tax treaty. In this kind of circumstances, the taxable item from host country would then have to multiply by the excess of the tax rate in home country when it is higher than host. However, it is worth noting, should the tax rate in home country is below the host, there is no additional tax to be paid to home country tax authority. In other words, nothing to be paid. So guys, keep an eye on the treatment of taxable item from host country. Finally, taxable item from home, which including transfer price income or contribution, will then have no doubts to pay at the full tax rate in home country. So these are the two tax cash flow items that one have to take note. Once done, we will then combine net cash flow remitted, home country cash flow, together with all the tax cash flow. That will give rise to net cash flow after tax finally. Then, these will convert into present value based on the discount rate. Guys, it is worth for you to take note. The discount rate applied can either be WACC or cost of capital of the company if both the risks of the FDI remain unchanged. Alternatively, a project-specific cost of capital will be used should any of the above risks on the FDI is different comparing to the present one in the home country. So with this discount rate, that will allow you to turn the cash flow into present value. Adding up all the present value, that gives rise to net present value that coach and lead to decision to be made on FDI. So guys, time for us to look at a demonstration on an exam questions. First and foremost, spend some time, go through the full of these questions on March 23, questions 3 on your own, and give a try on the answering part of these questions before watching the rest of the part of this video. The purpose of this video is to demonstrate especially the process of deriving the net present value. As such, part A on especially evaluating the suitability of the proposal of investment in this country, Uzbekistan, will be mainly discussed. Including in your analysis, discussions on the concern from the CEO will not be touched on in this topic explainer. And obviously, the discussions on part B pertaining to both of the risks were already mentioned a moment ago. Guys, give a try on this before referring to the model answer. As part of the answering plan for part A, to derive the findings to support the evaluation of the suitability for this investment, I will start putting out my answer in the word processor, starting with the requirement copy from the original source, and then telling the marketing team, I'm here to support the finding on the suitability of this proposal, referring to working one that expecting to have a lot of calculations to involve, which carry more than half the marks over here. And again, as mentioned, let's leave aside the concern from the CEO in this topic explainer, and I'm not going to touch on part B as well. So it is the W1 that we're touching on this topic explainer. To figure out what exactly is there to calculate, spend some time, go through the detail of the exhibits to start forming your answer plan on exactly what is there to calculate, how to plan out your workings. On the first exhibit, spend some time, take a look at the detail. It tells you about the present locations of B company, which is at Turkey. And then it goes on by telling you, with the success of the business in the home country, it is time for the company to explore the expansion plan to go into a broad country called Uzbekistan. And guys, here comes the second and the more detailed exhibits showing most of the content on the financial data pertaining to this project, including data such as exchange rate at this moment, and then it starts telling you financial modeling that used in deriving the forecast, particularly on the revenue. Then it goes on by providing some of the forecast financial data apart from revenue. It includes contribution, fixed operating costs, which are all denominated in dollar sign. What is dollar sign? It is the host country currency in Uzbekistan. Other than that, it starts telling you about the skepticisms that raised by the CEO about the financial modeling that require further verification. But anyway, that is not the main purpose of this video. Let's go on further to talk about what are the additional financial information. And the answer is, it starts telling you in order to kickstart the operations in abroad, we need to invest in additional asset, and that asset attract tax allowable depreciation. Then it talks about royalty payment to be made by the host country operation to the home country. Then it go on talking about tax information, followed by requirement of working capital. At last, it comes with inflation. And the good news for these questions is that the forecasted, the predicted exchange rate is already provided. Otherwise, it is either one of the model or parity that mentioned a moment that will be used to derive this forecast. The last clue, cost of capital of the company, in other words, WACC is provided. This hinted you the measurement to find out the suitability of this project with this cash flow and the discount rate is hinting about the calculation of net present value as such. So guys, this is one of the sample of my presentations on the NPV of the project based upon an FDI according to the framework and the plan that discussed a moment ago in this video. First and foremost, majority of the transactions are quoted in host country currency. As such, it will start with the dollar sign over here in million. And then, as what's the first tables provided, that is where the first set of financial data is coming in. I will therefore plug it in as a starting point to earn some easy mark. Knowing that all these are relevant cash flow, so this is all together. And then go on further to obtain another set of the financial data that is pertaining to the investment on the machine. Knowing that machinery itself is not attracting to any tax implication except tax allowable depreciation, I will therefore place the allowable depreciation for the tax purpose together with other taxable items. Whereas investing in the machinery as a cash flow would then park it after the calculations of tax. With this, it go on talking about royalty payment. According to the instruction and arrangement, this is a form of payment for whole country operation. As such, looking at the amount provided, these are the cash outflow for each of the relevant year. And let's not forget, this royalty payment is made to the home country. I would suggest, guys, while you're putting this as the cash outflow, let's not forget to leave some spacing on the top and go for the second half where all the cash flow are converted into home country currency, which is lira on Turkish currency in millions of the currency. So one of the items in the home countries, it's royalty income. So guys, as the original amount is quoted in host country currency, which therefore it requires a conversion into home country based on the exchange rates derived. And it is worth taking note, once it brought back as the income for the home country, these represent to be a cash inflow without a negative sign. So with this royalty payment, it go on to talk about the tax issue. So first, dealing with the tax in the host country, that will allow you to look at the calculations on tax cash flow based on the host country tax rate of 20%. And these require a taxable item. So what exactly are the taxable items? Please follow the instructions about what exactly the treatment will be made on the losses, which is true enough. Looking at the contribution, fixed cost, and the depreciation, including royalty, the result for the first 3 years of the business operation, particularly on year 1 and 2, is reported to be losses. So what exactly that is going to happen to the tax credit? According to the information over here, we're not allowed to claim the tax credit in that year. Instead, we are being allowed to carry these losses to the future year to offset the future profit. As such, this is how it presents on the carry forward of these taxable items to the subsequent year to offset. So coming to year 3 and 4, that is where the taxable income start to be of positive. That's where we can enjoy to offset the losses accumulated from the past to derive the taxable item in the year that based upon this number, we will then calculate the tax liability that is clearly only found in the 4th year of operations in this project. And let's not forget about when this cash flow is brought back to the home that will deal with it later, you need to deal with the home tax matter that will come later once you wrap up all the cash flow from host country. Finally, we talk about working capital requirement. So therefore, the working capital requirement, according to the information, is based on 2% of the contributions in the year. So I will then calculate the working capital required, offset by the working capital available to derive the changes in the working capital representing the cash flow. let's not forget about recovery of the working capital in the final year. So together with all this cash flow, and let's not forget about reversal by removing the tax allowable depreciation to derive the net cash flow after tax to be remitted. So guys, starting from year 0 column, looking at my cell of the formula, that is exactly what I'm doing. I'm picking up those items not only found in year 0 column, but it also happened in year 1, 2, 3, 4 column, so that I can copy this functionality across to each and subsequent year by dragging this little dot across over. So therefore, I bring in taxable item, tax cash flow, plant and machinery, changes in working capital, and reversal. These are the items that make up this total. I cross over by copy and paste this functionality to the rest of the 4 year. That gives rise to remitted amount of the net cash flow from host country. Converted at the exchange rate provided, that allows me to derive the net cash flow remitted into home country currency. Let's not forget about combining with the royalty income. Then only we deal with the last item of cash flow, which is tax. Bearing in mind, the tax cash flow for remitted taxable item, well, it's supposed to refer back to the taxable item above, converted to home country currency. But before you do all this, keep an eye on the tax rate. The tax rate in home is lower than the host country. Given the presence of the tax treaty, there isn't any need to pay extra tax. So as a result of that, the tax cash flow on remitted item from host country is nil. What we have to pay the tax is the royalty income as such. So once we obtain all the tax cash flow, we add up all together. That allows you to derive the net cash flow after tax. Converting at the discount rate of 16% as mentioned, that allowed me to derive the present value. With this present value adding up, that will give rise to a net present value. Finally, in lira, millions of currency. And finally, we're just going to extract the net present value derived into the word processor to highlight. That's the finding on the suitability of the proposal. Given the positive NPV, this project is suitable or acceptable. Then it carry on to respond concern of the CEO and part B of the questions, which is what you are supposed to handle on your own. So guys, I hope that by watching this video, that's gave you a more systematic way in dealing with the calculation of net present value in evaluating a foreign direct investment. With that, thank you for watching.